as a more normalized rate environment is a better environment for banks. Go from super low rate to a high or normal rate in 1 year. That's obviously very problematic for banks because a lot of them locked in loans to securities at lower rates. And then when you have like in basis point terms, the Fed's move is the biggest since like the 70s. And on a percentage terms, it's the biggest ever, going from zero rates as high as they did, as quickly as they did on a year-over-year basis. That's basically the biggest 1 year move.
Many observers of the Federal Reserve have long thought that it would keep increasing interest rates until it caused some sort of negative impact. Lyn Alden, who manages investments for her firm Lyn Alden Investment Strategy, now contends on forward guidance that the recent catastrophic failures of two major American banks mark the breaking point. According to Alden, this damage will soon lead to a phase of low actual interest rates, in which inflation surpasses the yields on Treasury bonds. Since March 10, two major banks in the United States, Silicon Valley Bank, SVB, and Signature Bank, have collapsed, marking the largest bank failures since 2008. The United States banking system has faced recent difficulties that resulted in the second largest bank failure in the country's history. The abrupt shutdown of Signature Bank in New York by state regulators on Sunday highlighted the critical need for exceptional measures taken by the United States to support the country's banking system and ease growing worries among customers regarding the security of their deposits. Prior to watching the video, please ensure that you subscribe to our channel and click on the bell icon to receive further updates. Let's hear Lyn Alden's perspective on the reasons behind these bank collapses.
Fight the last war. So a lot of people, when they hear banking crisis, they immediately think of 2008, whereas that was largely a credit event. Basically, banks made a lot of bad loans that were defaulting. In this context, it's not that bad loans are defaulting; it's that actually very, very safe securities were bought at high prices, low yields. And as we've entered a higher inflation, higher interest rate regime, many of them have unrealized losses, which for the most part for like a big bank is fine because if you hold to maturity, you're going to get your money back. But if their deposit base is skittish because say they have a high percentage of not insured large business accounts, they can pull funding quickly and make a bank sell those securities at a loss. And for Silicon Valley Bank's case, their losses were exceeding their capital because they managed risk poorly. But across the broader space, generally when they increased rates this quickly, it put a lot of pressure on the existing asset bases of pretty much all banks, but especially skewing towards the small and the medium sized banks, because when you have a liquidity problem in the banking system, it's not like liquidity can really leave the whole banking system quickly, but it can leave in any individual bank quickly, and so it can skew towards the larger banks and leave some of those small and medium sized ones dry.
Although this specific bank faced a solvency issue and others like it are also dealing with solvency problems, most banks in the United States are still financially stable. However, for many small and medium-sized banks, the primary issue is liquidity, and this concern may continue to worsen for them. She has noted that banks that can secure funding at low costs and manage their assets and liabilities well are better positioned to generate profits and withstand market fluctuations.
Liquidity and profitability kind of go hand in hand because if a bank wants to keep its deposits, one, it has to depositors have to have confidence in it, but then also if they want to avoid the long kind of drag of capital leaving them and going towards things like money markets, they have to increase their deposit rates, and that's where you enter the profitability problem. And so I would say for the long tail of small and medium banks, I would say it's both a liquidity problem and a profitability problem. Because those, one of the ways they can try to shore up their liquidity is by sacrificing some of their profitability. Um, for larger banks, it's less of a liquidity issue because they have, very very large and liquid securities books, diversified deposit base, and they now have access to the Fed's facility as well. So for them, it just becomes, I think, a potential question of profitability. If some of those maybe large regionals have to like raise their deposit rates more, I think to the extent that it becomes a profitability problem will in large part depend on the Fed. If they really push forward with tightening, that can continue to suck money towards things like money markets and away from bank deposits, and then that therefore requires banks to raise their deposit rates at a quicker rate. Whereas if the Fed eases off, that gives banks more of a reprieve.
Generally speaking, large banks are in a better position and may even have the ability to acquire market share from smaller banks. She tweeted, "Deposits can easily flow from one bank to another, but can't easily flow out of the banking system in aggregate. Big banks are rather safe, smaller and riskier banks less so. Most deposits would be nominally backed up by FDIC, even if it means printing new money to do so."
They are less impacted overall than the long tail of small and medium-sized banks. Because if you look at those large ones, some of them do have significant unrealized loan books, but they're in a much less likely probability of having to realize those losses than those smaller ones. That was even before the Fed facility, but now with that new Fed facility, there's even more defense against them having to realize those losses. But any bank up to, maybe not the top ones, but any bank is subject to deposit pools. And even if they have access to the Fed facility, that's still a higher rate than they get with deposits. So it still impair their profitability. So I think the overall space is less attractive, but it's already been rapidly repriced for that less attractive world. And so I'm not particularly pessimistic on, say, the top 10 banks, even though I am, you know, quite concerned about, say, that the long tail of the smaller banks.
It is often said that the Federal Reserve increases interest rates until something breaks. However, in the past year, a significant surprise has been that nothing has broken yet. To diminish the purchasing power of debt, the Federal Reserve limited all Treasury yields below the prevailing inflation rate. This strategy led to a threefold increase in the country's industrial production within 5 years.
They hold uh, flat this month, or if they go 25, I'd be surprised if they go any above that. I think it'll partially depend on what happens the next couple days. I mean, we're watching Europe have significant problems now, so some of this is contagious. Um, as for betting a year in the future, I mean, at that point, you're betting on human decisions. So in some ways, you're looking at numbers, but you're also betting on human decisions relative to those numbers. So I think a general framework investors have to have is that this decade, it's going to be very hard to have positive real rates and any sort of normalized persistent basis. There might be brief periods of time, especially in recessions, where you get to positive real rates. But the idea that we're just going to go back to like this long period of positive real rates like we had in the 80s and the 90s, for example, I think that's not going to happen. And the problem is that interest rates are, I think, going to be increasingly politicized. Right. So now that the Fed is unprofitable, now that small and medium-sized banks are pressured, um, we saw, for example, in Congress the other day. I mean, Elizabeth Warren was questioning Jerome Powell and basically saying, like, what are you going to say to the 2 million Americans that you're projecting you're going to put under work with your rate hikes? Basically, in these types of financial pressure scenarios, um, interest rates become very politicized. That both over the next year and longer term, monetary policy in many ways becomes politicized. The Fed essentially becomes the fourth branch of governments. And so it's hard to predict all out. But I think the baseline assumption or the baseline math, the way that it kind of works out, is that rates are going to spend most of their time submerged below inflation, with perhaps brief exceptions during disinflationary shocks.
Large banks are in a better position to weather the storm and even acquire market share from smaller banks. Liquidity is a major concern, especially for small and medium-sized banks. There is an urgent need for the country's banking system to be stabilized. What do you think about the current state of affairs amidst this financial collapse? We encourage you to share your thoughts in the comment section below. If you found this video informative, please give it a thumbs up. Don't forget to subscribe to our channel to stay informed on the latest news and videos. Thank you, and we'll see you in the next one.